All right, so I did a little bit of homework for the finance sector to replace Sun Life Financial, which has had a really nice run. And I do want to quickly say that I did find uh, the problem with the score, and sure enough, it was just a simple mistake. The actual up and standard deviation is what we're actually following right now, and the down and standard deviation comes very close, and that played a lot into what I chose for our financial company. And I'll go through that just really quick here. I want to first find uh, that portfolio that we were looking at, up and standard deviation. Just explain again, up basically is whenever there is more than average volume in a stock, it tends to move in a positive direction most of the time. And then standard deviation, of course, is just a measure of volatility. So what we have here is literally the up score minus volatility. And this has been the best performer for the past 12, well, past year, I should say. Anyway, and down in standard deviation comes in a very close second, and down is actually the opposite of up. So whenever there is more than the average volume of trading in a stock, these companies tend to move in a negative direction less than their peers. And then, of course, you subtract the volatility from that, and that's how you get the score for these guys. So what I did was looking at that and just the finance sector on its own. I looked at Toronto Dominion, of course, which is number one for our portfolio that we're following. The second best portfolio, which is the down and standard deviation, is this IVZ. And so looking at that, and also just curious because I'm looking at this really big dividend down here. I was looking also at BX. Another thing that's important to mention here, looking at the score for these, you see here that TD, Toronto Dominion, scored 2-4, and then MetLife down here scored a 2-4-5-4. It's basically the same score. But really quickly, though, I was able to see the big difference in these. And a lot of it has to do with the PE ratio, number one. You see here that Toronto Dominion has the lowest PE ratio relative to its peers than anyone. I mean, no one even comes close. The net profit, Toronto Dominion is at the top of the chart here. This is Wells Fargo, which is a bit higher. Um, I think this is Royal Canadian, it's a bit higher, but it's at the top. Same thing with operating profit, which is a really big deal for these banks because you're literally talking about the money you're bringing in minus your cost to make that money. So that's going to be a lot of your marketing and sales and stuff like that. And so these guys are really getting the job done. They aren't the best, but they are very close compared to IVZ and MetLife anyway. Return on assets, not such a big deal when it comes to banks. Lots of cash on hand compared to MetLife and IVZ. Um, a lot less, well, shouldn't say less debt, but definitely more cash. This is the thing that concerns me. TD is only 0.25% off of its high, which means that we're buying this thing at an all-time high pretty much. So not necessarily happy about that, but compared to what we have available, I think it's not a bad deal. Um, the alpha is a bit high, which concerns me only because looking at our heat map, um, that alpha, if you just take alpha purely by itself, it has been getting beat up past 6-7 months. I mean, when it's doing good, it's doing great. This was October 16 to March 17, so almost 6% a month on average. I mean, that's crazy. But these past 6-7 months, man, that alpha has taken a real beating. So that concerns me a bit, but I'm willing to ride it out. The other thing that I really liked was looking at the score for the up move. These three, just coincidentally, really are really close to each other. So MetLife didn't show up in any of our portfolios that we were looking at. Kind of curious as to what portfolio it did show up in, but it is, it scored really high. It's the second highest score. And then IVZ, like I said, was in the second best performing portfolio. So, these three are right there, scoring the best. But I liked this though. This is really made me feel good. This down move, okay. This thing is only moving 42% compared to some of the others in the sector. So that's pretty good. The beta is actually high. It's not as high as Sun Life Financial, which is a lot of reason why we got into Sun Life Financial in the first place. But compared to its peers, it's really good. So the return is pretty good. The look at this, the volatility. Of course, the volatility is much better than the other two companies here. So I'm more than happy to go into Toronto Dominion and really dig into the company and learn much more about it. So far, what I've gotten is that they've moved back into Japan a lot like Aflac has done for a long time. So they have some fixed asset stuff going, and of course their asset management is pretty good. Interest rates are going up, so all in all, finance is a good sector to be in right now. And Toronto Dominion's paying a decent dividend. The company's been around for a long time. So I'm confident that we'll be okay there. The other thing that I want to mention, I haven't done a lot of work on this, and I still have some work left to go. But this is the management score. This takes into account a lot of these ratios that you see here, such as the cash on hand, return on assets, operating margin, things of that nature, and the score is much higher than the other two that we were looking at. Looks like Sun Life Financial scores the best, and I know why. That has a lot to do with the cash to debt ratio. It's just blowing everyone out the water. So anyway, Toronto Dominion is where we're going, and